Welcome to the III Licentiate IC-01 Chapter 1 Explainer video from the Insurance Domain Training Center. We have launched this licentiate video series to support candidates who are preparing for the licentiate examination conducted by the Insurance Institute of India. Our objective is to help you understand the concepts through simple explanations, practical examples, and exam-oriented discussions that make your preparation easier and more effective. In this video, we will cover Chapter 1, Introduction to Insurance. Before we begin, please take a moment to read the following disclaimer.
Before we begin, please take a moment to read this important disclaimer. This video is an independent educational resource created by the Insurance Domain Training Center to help learners understand the concepts covered in the III Licentiate exam IC-01. We are not associated with or authorized by the Insurance Institute of India. For examination purposes, please refer to the official study material and any instructions issued by the Insurance Institute of India, as those remain the authoritative and final source. Thank you. Let's begin our learning journey. Before we begin, here's how to get the maximum benefit from this video. This learning video is developed by drawing inspiration from Richard Mayer's pre-training principle. For each section, we first provide a brief overview of the key concepts. Once the entire section is complete, we revisit the same concepts with visual explanations and practical examples. This two-step approach helps you understand the big picture first and then reinforces your learning through examples. For the best learning experience, keep your Insurance Institute of India Licentiate IC-01 textbook with you and follow the same chapter as you watch this video. Finally, test your understanding by attempting the chapter questions before looking at the answers. Now, let's begin. The IC-01 book, Principles of Insurance, introduces the fundamental concepts of insurance. It also covers the basics of underwriting, claims, reinsurance, and insurance accounting. In this video, we are covering Chapter 1, Introduction to Insurance. The objective of this chapter is to introduce you to the fundamental concepts of risk, insurance, how insurance works, and its need and benefits. For easier understanding, we have divided this chapter into 3 sections. The first section covers risk concepts and risk management. The second section explains how insurance works. The third section discusses the need and benefits of insurance. Let's begin with the first section, risk concepts and risk management, and see what it covers. We are now in Section 1. The objective of this section is to help you understand what risk is and how it is managed. We cannot study insurance without first understanding risk because insurance is one of the most important risk management techniques. In fact, the concept of insurance has evolved from the broader concept of risk management. In this section, you will learn what risk is, the difference between pure risk and speculative risk, the risk management process, and the various methods of treating risk. Most importantly, you will understand how risk management is connected to insurance. You may be wondering why you need to study risk management when your goal is to learn insurance. The answer is simple. Insurance itself is one of the techniques used to manage risk. That is why the Insurance Institute of India has included this topic at the very beginning of the course. Now, let's begin with the concepts covered in Section 1.
Let's jump straight into Part 1, Concept and Management of Risk. So, what exactly is risk? Well, by definition, it's the possibility of an adverse deviation from an expected outcome resulting in a financial loss. Basically, things going wrong. If you plan a picnic and a sudden rainstorm completely ruins it, yeah, that is definitely a deviation from your fun day out. But, and this is key for beginners from an insurance perspective, we are specifically looking at deviations that cause a financial dent. We're talking about a flood destroying goods in a warehouse, not just a ruined Sunday afternoon. Now, here is where it gets kind of fascinating. There's a massive difference between a completely random event like an earthquake, which you absolutely can insure, versus taking a calculated business gamble, which you cannot. We call these pure risk and speculative risk. Pure risk only causes a loss or no loss at all. It's totally involuntary, like a coconut randomly falling on someone's head or a sudden factory fire, because there is zero chance for profit. Pure risks are insurable. Speculative risk, on the other hand, is voluntary. It's like putting your money in the stock market. You could profit, You could lose it all, or you could break even. Because you consciously take this gamble hoping for a gain, it is strictly not insurable. No way. And that brings us to the risk management process. This is basically how an enterprise, or honestly, even just you and me, systematically spots, measures, and then handles those potential threats. Step 1 is risk identification, sniffing out every conceivable risk. Step 2 is risk evaluation, measuring those risks by multiplying how frequently they might happen by how severe the financial loss would be. And step 3 is treating those risks. Think of step 3 like a toolbox for handling danger. And you've got 4 main tools. First is avoidance, like just deciding, hey, let's not build a new factory right on top of a major fault line. Then you've got mitigation, which is all about prevention, like wearing a motorcycle helmet, or reduction, like installing fire sprinklers just in case. Tool number 3 is retention, where you just keep enough cash saved up to absorb the hit yourself. And finally, transfer, passing the financial burden over to an insurer. The big takeaway here, buying insurance is just one tool in your risk management toolbox.
Now you have completed the brief overview of a section. Now let us revisit the same concept with more details, with visuals and explanation. Let us jump in.
Priya. She just bought her first car. She's excited to drive to work, but the moment she backs out of her driveway, she steps into a world of uncertainty. A minor accident, puncture, or severe weather could happen on any given day. In the insurance industry, we define that uncertainty precisely. Risk is the possibility of a deviation from an expected outcome. Priya expects a safe, smooth commute. A crash is a sudden, costly deviation from that expectation. This layout shows two risk categories. Left is pure risk causing only loss with zero profit possibility. It's involuntary. Priya didn't choose to crash. Right is speculative risk, a chance for profit or loss. You take this voluntarily, like investing, hoping for a financial reward. A crucial rule for your exam: the insurance industry only exists to cover pure risks. You cannot buy a policy to cover a speculative stock market gamble. Because our daily lives are filled with these pure unpredictable risks that offer no financial upside, society requires a reliable systematic way to handle them. That systematic approach is called risk management. It's the formal process we use to treat the pure risks drivers like Priya face on the road. There are 4 main ways to do this. The first method is avoidance. Priya could eliminate the risk of a car crash entirely by choosing to never drive or ride in a vehicle again. But for most of us, avoiding the risk completely is impractical. The second method is mitigation and prevention. By wearing her seat belt and obeying the speed limit, Priya takes actions to reduce the chances of an accident happening and lessens the severity of the damage if one does occur. The third method is retention. This is when you choose to absorb a small, manageable financial loss out of your own pocket. If a stone chips Priya's side mirror, she can likely handle that minor repair cost herself. The fourth method is transfer. If Priya's car is completely damaged leading to total loss, that's a massive financial blow. Instead of trying to absorb it, she shifts the financial burden of that catastrophic loss to an insurance company. Driving carefully reduces danger and paying for small repairs handles minor costs. But for rare events that are too expensive to pay for and too difficult to avoid, transferring the risk is the primary way we stay financially secure.
Congratulations! You have completed Section 1, where you learned what risk is and how risk management is connected to insurance. We now move to Section 2, how insurance works. This section helps you understand the bigger picture of how the insurance system operates. Let's begin with a simple example. Imagine you are buying a product from a shop. Before selling the product, the manufacturer already knows the cost of raw materials, manufacturing, transportation, marketing, and other expenses. Now compare that with an insurance company. For an insurer, the biggest monetary outgo is paying claims. But when an insurance policy is issued, the insurer does not know who will make a claim, when the claim will occur, or how much it will cost. So how can an insurer successfully operate a business under so much uncertainty? What principles make this possible? What happens when those principles don't work as expected, such as during catastrophic events? And how do insurers manage those situations? Let's explore how insurance works.
Along to part 2, how insurance actually works. Okay, let's get into the actual mechanics. Insurance at its core is a formal loss sharing arrangement. Now, unlike a group of villagers informally passing a hat around to help out a neighbor, modern insurance is a highly organized, legally binding contract between the insurer and you, the insured. You pay a small fee, which legally is called a consideration, but we all know it as a premium. And in return, the insurer promises to compensate you for losses, but only if those losses come from a specifically agreed upon insured peril, like a fire or a theft. But wait, this brings up a really mind-bending mathematical puzzle. Think about it. An insurance company takes on the risk of hundreds of thousands of people without knowing exactly who is actually going to suffer a loss. So, how do they know they won't just go bankrupt overnight? How on earth do they predict the unpredictable future to calculate a fair premium? The answer is statistical cornerstone, and it's basically the secret sauce of the whole industry. Published by Jacob Burney way back in 1713. This is the absolute magic formula that makes insurance possible, the law of large numbers. It states that as the number of trials of a random process increases, the percentage difference between the expected outcome and the actual outcome shrinks closer and closer to zero. If that sounded like jargon, let's use a basic coin toss to make it crystal clear. We all know flipping a coin gives you a 50% probability of getting heads. Right now, if you flip it just 10 times, you might randomly get 7 heads. That's a huge deviation. But if you sit there and flip it 100,000 times, the end result is going to magically balance out to be extremely close to exactly 50%. This brilliantly illustrates that while predicting whether one single car will crash is totally impossible, predicting the accident rate for 100,000 cars is statistically super accurate. So, because insurers don't have absolute perfect certainty like a coin toss, they have to study mountains of past data over a massive number of exposures and a long period of time to accurately estimate future losses to smooth out weird outlier years, like say a sudden pandemic lockdown that completely empty the roads. Companies rely on vast amounts of historical data to set their pricing correctly. However, statistical laws are not universal physical laws. The sun's going to rise tomorrow, sure, but human behavior that changes constantly. And that means past data doesn't always predict the future. Actually, unexpected upheavals can make historical data obsolete overnight. Think about emerging risks like complex cybercrimes or climate change, where we just literally don't have a century of data to study. Plus, huge catastrophic events can cause unexpected massive accumulations of loss. Even new court judgments can suddenly expand liability claims, making them way more expensive than an insurer ever predicted. So, how do they survive these shocks? Well, to protect themselves from nasty surprises, prudent insurance companies actually go out and buy their own insurance. It's called reinsurance. They also use advanced predictive modeling and cutting-edge tech. They hire brilliant mathematicians called actuaries to refine these estimates using advanced science. And most importantly, they constantly build up huge piles of capital and financial reserves, so they always have enough cash on hand when the unexpected hits.
Now you have completed the brief overview of a section. Now let us revisit the same concept with more details, with visuals and explanation. Let us jump in.
What exactly is insurance? It is a formal legal contract. At its core, it is an arrangement where a large group of people agree to share the burden of individual losses. The financial mechanics work like this. The person seeking coverage pays a fee called a premium. This payment serves as their contribution to the contract so that in return, the insurer promises to make good on losses caused by specific events, which we call an insured peril. This brings up a major logistical question. How can an insurance company make massive financial promises to millions without eventually going bankrupt? This statistical visualization shows the law of large numbers in action. If you toss a coin once, the result is completely unpredictable. But as you scale up to 100,000 tosses, the chaos smooths out into a highly predictable 50/50th probability curve. Mathematical professionals known as actuaries apply this exact law to insurance. They cannot predict if Priya specifically will crash on a Tuesday, but by grouping together 100,000 drivers, they can forecast total accidents across the entire pool with remarkable accuracy. The entire insurance industry operates on this conversion. It takes individual unpredictable chaos and turns it into collective predictable certainty. However, the law of large numbers is a statistical tool, not a physical law of nature. And that means past data cannot perfectly guarantee future outcomes. A sudden, unpredictable catastrophe throws standard actuarial predictions out the window. A massive flash flood that simultaneously destroys thousands of cars in a single neighborhood is a shock the math didn't anticipate. To survive these massive shocks, insurers rely on reinsurance. This flowchart illustrates how a primary insurance company takes a percentage slice of its own total risk pool and transfers it up to an even larger global reinsurance entity. Insurers also employ advanced predictive modeling technology to spot emerging weather trends, and alongside insurance, they purposefully build massive capital reserves to act as a financial buffer when actual losses overshoot their estimates. To successfully act as society's shock absorber, the system itself must continuously manage, buffer, and transfer massive financial risks.
Congratulations! You have completed Section 2, where you learned how insurance works. We now move to Section 3, Need and Benefits. This section helps you understand why we need insurance, meaning requirements for insurance. Also, this section explains what is the benefit that insurance provides for an individual and also to the society. Let us explore.
Need and benefits of insurance. Insurance provides incredible fundamental protection and stability for both you and massive businesses. But beyond just getting some peace of mind, insurance is often mandatory. It's literally required by law before you can even drive a scooter off the lot, thanks to the Motor Vehicles Act. It's also demanded by banks. A bank isn't going to lend money to a local factory unless they know that factory is insured against fire or floods. It's woven into the very contracts that keep our entire business world moving. And the benefits ripple out way beyond just fixing broken stuff. For example, life insurance policies act as massive savings instruments. Insurers take all those tiny premiums we pay and invest them straight into critical long-term national infrastructure. They're huge engines for economic development. Insurance also naturally minimizes loss because you have a deductible. You're financially incentivized to drive safer and lock your doors, right? Ultimately, insurance isn't just a safety net. It is a foundational pillar of our modern economy that allows trade, commerce, and innovation to grow without the paralyzing fear of one disaster ruining everything. As we bring this explainer to a close, I really want to leave you with a thought to chew on. In a world completely full of unpredictable, pure risks, are you actively managing your exposure? Or are you simply leaving your financial future to chance? Understanding these basic principles of risk, the amazing law of large numbers, and the sheer power of protection gives you the toolbox you need to make with smarter choices in your own daily life. Thank you so much for diving into the basics of insurance with me today.
Now you have completed the brief overview of a section. Now let us revisit the same concept with more details, with visuals and explanation. Let us jump in.
Priya. Like all of us, Priya faces tiny risks every day. If she drops her bicycle and gets a minor scratch on the paint, it's annoying, but it's a financial loss she can afford to fix from her own pocket. But what happens if Priya buys a brand new car and it gets crushed by a falling tree? That is a massive, catastrophic financial hit. Repairing or replacing an entire car can easily exceed her personal bank balance. This textbook excerpt on protection highlights a simple truth. Every single person has a strict limit on the amount of loss they can personally absorb. That limit is determined by their own income and wealth. Insurance exists to protect us from those financial disasters that exceed our personal limit, the heavy losses we simply cannot afford to bear on our own. To obtain this protection, we pay a small, definite amount of money today, known as the premium. In return, insurance provides a financial safety net for us and our families. We may not know when an unexpected event will occur, but the protection is already in place. Looking at this section on security, we can see why people choose insurance. A future loss is uncertain in terms of when it may happen, where it may occur, and how much it may cost. People are willing to exchange a small, affordable payment today for financial protection against a potentially large future loss. They accept a known, manageable cost now to avoid the possibility of severe financial hardship later. Meet Rahul, who owns a local garment factory. In business, A single unforeseen event, such as a warehouse fire, could wipe out an entire year's profit and even force the business to close. Without insurance, Rahul would need to keep a large amount of money aside just to prepare for such emergencies. With so much money kept in reserve, he would have less to invest in expanding his business, hiring more employees, or purchasing better equipment. When Rahul purchases insurance, he transfers much of that financial risk to the insurer. He can confidently invest his capital in growing the business, knowing that insurance provides financial protection if a major loss occurs. As explained in the capital section, insurance compensates for unforeseen losses, reducing the amount of capital a business needs to keep aside for unexpected events and lowering the risk of financial distress. Insurance therefore acts as a catalyst for business growth. It enables entrepreneurs to invest their money productively instead of keeping it idle for emergencies. When businesses plan to expand further, they often seek loans from banks. Banks usually require the borrower's physical assets to be adequately insured before approving such loans. Insurance gives lenders greater confidence that the assets securing the loan will remain protected. Governments also require certain types of insurance to safeguard the interests of the public. For example, commercial vehicles operating on public roads are generally required to carry liability insurance. The textbook explains this under the legal compliance section, referring to laws such as the Motor Vehicles Act, which mandate this coverage. Insurance therefore provides the confidence that supports modern commerce. It gives banks the assurance to lend and helps governments protect the public. Insurance also contributes to long-term financial planning. Many life insurance policies encourage disciplined savings, helping families build financial security over time. Insurers also promote safer behavior through a concept known as loss minimization. For example, safe drivers who do not make claims may receive a no-claim bonus, reducing the premium they pay. By rewarding careful behavior, insurance encourages safer driving and helps reduce accidents for everyone. But what happens to the millions of small premiums collected every day from people like Priya and Rahul? Those individual contributions are pooled together into a large financial fund. Insurers invest these funds in long-term projects that support national development, including highways, bridges, hospitals, and other infrastructure. As explained in the sections on investments and social security, insurers also support government initiatives such as disaster relief and health protection for economically weaker sections of society. Every insurance policy may begin as protection for an individual or a family. But when millions of such policies are combined, they create a powerful financial system that supports businesses, protects communities, and contributes to the development of the nation.
Congratulations! You have completed the lecture for Chapter 1 of IC-01. It's now time to test your knowledge. Let's move on to the questions.
Is testing your knowledge of what you have learned in this chapter. We have prepared 10 questions to help you assess your understanding of the concepts covered in this video. For each question, we will read out the question and the answer choices. You will then have a few seconds to think and choose your answer. In the following slide, we will reveal the correct answer and explain why it is the right choice. So, let's begin with question 1. Your first question. Risk is defined in insurance as the possibility of an adverse dash from an expected outcome resulting in a financial loss. Read all the options. Have you chosen the answer? Pause the video if you need some more time. The correct answer is option B, deviation. Risk is the possibility of a deviation from an expected outcome. In insurance, if specifically refers to an adverse deviation resulting in a financial loss. Your next question. The insurance industry only exists to cover. Read all the options. Have you chosen the answer? Pause the video if you need some more time. The correct answer is option C, pure risks. Insurance covers pure risk situations that cause a loss and never a gain, with zero possibility of a profit. It structurally excludes speculative risks.
Question number 3. Speculative risks are not insured by insurance companies because. Read all the options. Have you chosen the answer? Pause the video if you need some more time. The correct answer is option E. All of the above. There are 4 reasons why speculative risks are not insured, including the voluntary nature of the risk, the reluctance of people to share profits, the unpredictability of speculative ventures, and the need for enterprises to naturally bear risk for profit.
Your next question. Insurance provides which of the following benefits to society and business? Read all the options. Have you chosen the answer? Pause the video if you need some more time. The correct answer is option E, all of the above. The benefits of insurance includes facilitating lending, providing stability, serving as an investment engine for infrastructure, and promoting loss minimization.
Your next question. Who first published the work detailing the law of large numbers in 1713? Read all the options. Have you chosen the answer? Pause the video if you need some more time. The correct answer is option B, Jacob Bernoulli. Jacob Bernoulli made a great contribution to the field of mathematics and insurance by publishing his law of large numbers in 1713, creating the framework for predictable risk pooling.
Your next question. Which of the following is an example of risk avoidance? Read all the options. Have you chosen the answer? Pause the video if you need some more time.
The correct answer is option C. Deciding not to build a factory in a seismically unstable area. Avoiding building a factory in a seismically unstable area as an instance of risk avoidance.
Your next question. The law of large numbers states that as the number of trials of a random process increases, the percentage difference between the dash and actual values goes to 0. Read all the options. Have you chosen the answer? Pause the video if you need some more time. The correct answer is option B. Expected. As the number of trials of a random process increases, the percentage difference between the expected and actual values goes to 0.
Your next question. During risk evaluation, the gravity of a risk is measured by multiplying dash by severity. Read all the options. Have you chosen the answer? Pause the video if you need some more time. The correct answer is option D. Frequency. Risk gravity is measured by multiplying frequency and severity.
Your next question. Fill in the blanks. In an insurance contract, the fee paid by the insured to the insurer is legally called dash. Read all the options. Have you chosen the answer? Pause the video if you need some more time.
The correct answer is option A. Consideration premium. Insurance is a contract whereby the insurer, for a consideration called premium, agrees to make good the loss. Your next question. Which of the following terms matches closest with a priori knowledge? Read all the options. Have you chosen the answer? Pause the video if you need some more time. The correct answer is option C. Knowledge known before conducting the experiment. A priori means knowing something before the experiment is performed. For example, before rolling a fair die, we already know that the chance of getting a 3 is 1/6, 16.67%. This knowledge comes from the rules of the experiment, not from actually performing it.
Came to the end of the chapter. Hope this video is helpful. If it is helpful, please like the video. Subscribe to our channel to get notification when we upload new video. Join our mailing list in www.insure.com. Please feel free to provide your comments and feedback for us to improve better. Thank you very much for watching the video.